Welcome everybody. My name is Diane Sawyer. I am the president of the Reidsville Chamber of Commerce, and we are really excited to be here, wrapping up our sessions that we have been doing over the course of the summer, our topics at 12 on Thursdays. That has been presented by the Small Business Center of Rockingham Community College, and our representative there, Susan Reagan, who's the director, the Reidsville Chamber, Team Reidsville, and Rockingham County Economic Development Office. We are really thankful for this collaboration. It's a lot of folks have been behind the scenes pulling together resources for small business. So thank you for joining us. We are going to turn it over to our presenter. Today we're going to be discussing lending for small business, and it's presented by John Kolessar with BB&T, now Truist. So welcome, and John, take it away.
Diane, thank you. I appreciate you and Susan for allowing me to do this today. I think it's vitally important, especially in the state of our economy today, with how COVID-19 has basically changed all of our lives, and especially our small business owners. You know, there's a lot of people that are doing fairly well out there right now, and there's others in the entertainment space that are really struggling. So hopefully this will give small business people the opportunity to know what the financial institutions are looking for whenever they're going to apply. Next slide. Lending to startup businesses. There's really two different areas that you can go into. You can go to your local bank and financial institution to get a business loan, or you can go through the government process, which is SBA lending. Next slide, please. What I'd like to do is just take a moment and just define the startup of a small business, the way the financial institutions and the government look at small institutions or small businesses. It's business that have been in operations for 2 years or less at the time of a loan request. Next slide. I also would like to inform people the Triad Biz, this is their information. They're saying that in the startup businesses that go out there, 50% of them fail because of incompetent experience, especially online fraud, and lack of experience in the industry. 80% of businesses that fail are predominantly cash flow driven. So just because you're really good at your craft, you know, you could be a hairdresser, a plumber, and you could do a really, really good job at what you do. But if you don't have the business side of it, it makes your business more challenging. So I would highly recommend that you take a class or two on the business side and really understand the industry going into your startup business. Next slide. One of the key factors when you're starting up a business, I highly recommend 3 things that you do right off the bat. And it's actually part of your organizational structure. You need to find a very good lender of choice that you feel comfortable working with at the financial institution that you may bank at or that you don't bank at. The second thing I would do is advise yourself with a good CPA or an accountant that can help you with the financial structure of your business. And then lastly, I would try to find an attorney that can help you with the organizational structure of what type of business that you want to become. So not only do you need to know your craft, but on the business side, you need to know how you're structured. So I have a few here for you to see. You can become an S corporation, LLC, PLLC, a sole proprietor, or a C corp, just to name the most common ones that are out there. The difference between the two in bank financing and SBA financing, I'm going to walk you through the bank financing piece. That's the piece that I'm most familiar with for startups, but there's also a SBA process that I'll go through at the very towards the end of the presentation here. But when you have bank financing, the approval comes through the bank only. It's not required to go through the Small Business Administration. Next slide. The information that you will need when you're applying for a small business loan is we're going to need a personal financial statement. And when you go through and you receive a personal financial statement, I just want to give you an idea of a few things that are on that personal financial statement. So they're going to ask you your name, your social security, your address, birth date, the name of your business, the street address of your business, and then they're going to ask you some key information that goes along with that that's going to help us make the lending decision. And I'll go through that on the next slide. But you also need 2 years of tax returns. If you are a startup business, less than 2 years, we'll need your last year's business tax returns. We would like to know your past experience in the field. Just because you've started up the business, did you work 20 years in that business, or is this just brand new? We also would like projections that if you get this loan, how are you going to repay the loan back? So we ask for 1 year projections. And then back to the last slide, when I'm asking you about your structure of the organization in the S corporation, LLC, or so forth, there's also a taxpayer ID attached to that that identifies you through the federal tax department of what identifies that particular business. Next slide. So the personal financial statement. In a personal financial statement, it's a list of things that we would ask you, and one of them would be, how much cash do you have on demand? And what we mean by that is what's in your checking account, what's in your savings account, personally, not in the business, personally. If you're a startup less than 2 years, then you'll also have hopefully business cash as well that we would add somewhere else. But on the personal financial statement, we're just asking things on the personal side. And the other things down there as well is, you know, what type of life insurance do you have, marketable stocks and bonds, closely held business. So just because you're starting up this new business doesn't mean that you don't have another business that you already have formed and it's in existence, but maybe you're not a complete owner. And in this particular business, you want to be a complete owner, and you would list that business and your ownership that you would have. Vehicles, real estate, investment accounts that are on the retirement side, like 401k, IRA, so forth. And other assets would be like the other assets that are in your home. And then other loan payables is what I like to call that. Those are like credit cards and things of lines of credit that you have personally in your personal name. Next slide, please. The business loan application. The business loan application is a vital part of, we want to know what is the purpose of the loan so that we're able to structure your loan process correctly. So what do I mean by that? Say that you're an existing business owner less than 2 years and you are wanting to buy a building instead of work out of your home. Well, we would put that structured piece in a loan instead of a line of credit. However, if you buy that building and you want to do some upfits to it, then we would attach also a line of credit to that so that, you know, I know that the estimate is $15,000, but I would like a line of credit of $20,000 to do the things that I would like to do. And we may have overages and shortages, and I don't want to pay on something interest like a loan that I get all the money up front. I'd rather have a line. And then the last bullet there is, what is it going to be used for? And I just kind of went through the two scenarios of a loan and a line. Next slide. Concerns and hurdles for most of small business owners It really comes down to understanding the business side of it. There again, you're very good at your craft, whether you're a plumber and going out to the house and fixing the problem, but you may not really understand cash flow. And that's really where your banker and your accountant will kind of help you through understanding the cash flow of when you get paid and when your obligations are expected to be paid. And then, of course, you want to get paid. And that is kind of a short circle to a cash flow of you doing a job and, you're out the money for doing the job. And then you obviously need to live and get paid. And then actually when the customer pays you, that's kind of a short triangle of cash flow. And other hurdles are understanding your competition and what you're entering into, products and services. How are you going to get the products and services that you need in a timely manner to be able to do the job quickly? In-home and out-home, actually, this has become a really essential in the COVID-19, because you may choose to do something like staying with elderly people or staying with people that are requiring you to go in the home right now. So one of the hurdles that we're seeing with some of our existing business clients is, what do you need from an in-home or out-home of understanding that and how COVID has impacted it. So next slide. Bank approval. So when you're going through this, the bank is taking on 100% of the risk on a business loan. So you need to make sure that you're very methodical and that you have a good plan and process in place. And one of the key ingredients that I alluded to early is to make sure that you have a good attorney, an accountant, and a banker. And these things come a little bit easier in the bank approval process because each one of them will lend a hand in the process to help you get approved. Next slide. So if you look back at small business in a startup instance, you're seeing that it really relies predominantly on your personal finances. Your personal finances and how you paid them in the past. And maybe if on your personal financial statement, if you're able to attach something personally on the collateral side, then that helps you get a small business loan early on in the process. So as you can see, the personal side is so important in the decision-making side for a financial institution. So that lends me to the small business lending piece. And what this is, and I'm kind of defining this in my own terms, it's a partnership between the bank and government banking finance. So this is where it's vitally crucial that you bring all the things to the table whenever you're applying for an SBA lending, because now you've got two people that you need to satisfy. Next slide. So why would you choose SBA lending over bank lending? And there's a few reasons why. Maybe you don't have the collateral personally or in your business. There's a shortfall there, and we would use government financing through the SBA lending arm that would provide that for you. Or maybe that you don't have enough money in your business account for the down payment of 15% to get the small business loan through your bank to get the 85% financing and 15% down payment financing. Or maybe the terms and conditions really don't match up with your cash flow, and you might need to extend the term of a note which is outside of the lens of what the financial institution is willing to do. They'll approve you, but they just can't do it through the terms of conditions of what they're doing. And SBA can sometimes go out longer than what a bank would. or it could be your experience in the industry. Say that you are today, you work in a manufacturing facility of some kind, but you've got your cosmetology license now and you want to go into cosmetology. Maybe the financial institution just don't feel comfortable enough for you making that transition based off of your personal finances of making that jump into your new career. And we might need some help through the SBA to get you through that point. So that's what those bullet points really mean there as far as why you would choose SBA lending. Next slide. SBA requirements. So since it's a partnership between the bank and the government, then all the information that you filled out for the bank, which I listed earlier in the slide of this presentation, we would use that information, but then there's some other things that you would be required to do from the SBA side. The SBA requires you to do a more in-depth vision plan, business plan, than what you would have to do at your financial institution. And in that are a few areas that I'd like to kind of go over. The executive summary. That would be a snapshot of your company, explaining who you are, why you're doing what you're doing, and who would use those services. And that needs to be about a page, page and a half of explaining your business. The other part is the business description and vision. We want to know or the SBA would like to know what the mission, vision, and your values and goals and objectives are, and then a brief history of the business or business experience that you have in that. Definition of the market, making sure that you understand the business industry that you may be entering into, or a business industry that you're already in, but you want to own your own business, making sure that you understand that industries, because all industries are a little bit different in that, some are just nice and steady. Some have peaks and valleys of when they do a lot of business and when they don't do a lot of business. And I take our retailers, if you're around Christmas time, the retail market just explodes because everybody's out shopping right before Christmas. So I would say late October, November, and the first part of December, the retailers do really, really well. Well, unfortunately, when January and February come, our retailers don't do quite as well because everybody's paying back that money that they spent majority of the time for Christmas. So that's an industry cycle that kind of has ups and downs. So you would need to know your market. Products and services, that's really, go back to a plumber. Products and services, that you got a supply chain, and especially right now in COVID-19 that we're dealing with, how long does it take me to get what I need in order to help my customer? So products and services, where am I going to get it? And then how am I going to service it? We would want to know a complete picture of how you're going to execute that through the SBA lending. Organization and management goes back to earlier in the slide of the structure of your organization. So are you a S corporation, a LLC, a PLLC, a C corp? They would want to know that structure, and if there was any special licensing or permits that allow you to do what you do, because that would be barrier of entry things, which would be very good for you. For us to know whenever we're doing SBA lending. Marketing strategies, really would like to know, how are you going to market yourself? A lot of people today, especially in the COVID world, they're doing it through Facebook, all these other social media strategies that they're using. Some people still use brochures and things of that nature to get the information in people's hands. Or, one of the best strategies is word of mouth. People that know that you do good work and you're just going out on your own, word of mouth can be some of the best advertising in the world. Is that, take me for instance, is that, hey, John's going to go out there and open a bank or something. I'm not going to do that, but I'm just saying, word of mouth could be the best way of advertising as well. And I skipped one up there, management. Management is crucially important that the SBA understands what type of management experience that you have or that you bring to the table, or quite frankly, what you might not have, so that we're able to understand how your organization is going to be ran. Financial management, I will go more in depth in the financial management piece on the slides to come, but really the last thing that really differs outside of traditional bank lending and SBA is the SBA application. You will be required to also do an SBA application, pretty much a lot of the same information that your business loan application had on it. You'll be required to do an SBA application for them. It's just on their letterhead and their information. Next slide. Financial management for new businesses. One of the things that both the bank and the SBA requires is estimated startup cost. We need to know how much is it going to cost to purchase a building or to start your business and so forth. And the things that we're going to require is projected balance sheet and projected income statement for 1 year forward of what it's going to look like after you were to get that loan. The other thing which is very important is projected cash flow statement for 12 months. How is that loan going to be repaid? And whenever we do this loan or line, how will that help you with making additional money to be able to pay back the loan? And with the regular bank, we only need 12 months of cash flow statements month by month, but the SBA requires another 2 years annually after that. Like if you were to get one today, we would want to know the next 12 months through middle of 2021, and then you could give a breakdown monthly, and then you would have to do an annual for the next 2 years for 2022 and 2023. Next slide, please. SBA approval. A lot of people think that whenever they get an SBA loan, the government was the only one that approved the loan. That is not correct. Both the SBA and the bank, based off of the request, have to approve the loan. So next slide. And this is why. The SBA risk associated, you can see here that the government is taking a lot of the risk away from the bank, but you can see in a partnership, you have to get both approvals, because in most instances that I see, it's either this breakdown. The government will take on 90% of the risk and the bank will take on 10% of the risk. And sometimes they'll do an 80-20 where the government takes on 80 and the bank takes on 20% of the risk. And majority of the time it is on the bank's books that this loan or line of credit would go on. Next slide. Okay, well, that is pretty much my presentation today on for startups, between the different lenses of your financial institution and going through the government financing piece. And what I wanted to do now is just kind of open it up if anybody had any questions on either one, whether going through your traditional bank or going through the SBA lens.
So John, I had a question that came through the chat that was asking about explaining the timing for a bank loan versus an SBA loan, application to receipt of the funds, and the typical versus extended. So just kind of all of those pieces, how it works.
Okay, well, that's a tricky question, and I'll tell you why it's tricky. It really just is based off the request. So I'll give you an example. Say it's a piece of rolling stock, and it's a client that would like to purchase a van for their business. I can do a business loan for a van within 30 minutes to an hour on the bank side. Obviously, if you have to go through the SBA, that process would take 2 to 3 weeks. Now, I want to kind of give you more of a realistic timeline. Let's say that you're purchasing that building. That's a little bit longer of a timeline anyway. So if you're purchasing a property, the timeline traditionally for that through the banking, you would probably get in 3 to 4 weeks. There's a lot to do. You got to do title searches. You got to do appraised values. You got to do a lot of things in the process that traditionally through the bank, it would probably take 3 to 4 weeks. If you were to do that same loan through the SBA, Diane, you're probably looking anywhere between 5 to 6 weeks, just because you got that extra step. And you got to remember, the bank is only taking on 10 or 20% of the risk, and the SBA is taking on the other 80, 90. Did that answer?
I think it did. I think it did. And I think a lot of people are really confused. So this is going to be helpful because the pandemic brought on so many questions about lending where people were looking for help. And you have the PPP, and then you have the EIDL, and we did specific webinars on those. And EIDL money existed beforehand, and the SBA existed beforehand, but some people didn't know about them until the pandemic. It was like, it brought to light the SBA and some of the options that they do. So I think it was really good to talk about just traditional, like bank lending and SBA lending for businesses all the time, not just during the pandemic. So I think this is a really good topic. I think that covered, some of the differences that people need to understand. And I have another question that came in the chat box about how a non-traditional business startup, such as new media or internet-based, what steps that they would need for that sort of lending.
I got to be quite honest with you, Diane. I have done very little media online business startups, but it would traditionally be pretty much the same. It just requires a full disclosure of what you're really trying to do to get that startup business started. So, if you got an equipment list for that startup business, if it's through servers or laptops or whatever it may be, we would need to really know the full understanding of starting that business up so that we can kind of help the business owner figure out a way to get that lending process. And I'll be honest with you, Diane, in Rockingham County, I've been here since 2006. I've done very little of that. I've done very little media, that type of industry lending, to be quite honest with you. So that would be something that I would need some help on.
Okay. And I think that you still covered, the question, and I think that you'd be able to help them. One of the questions, another question that came through the chat box was discussing credit and how businesses can improve their credit before going to the bank if they're trying to build towards that. And I think that's something a lot of businesses still don't understand how that correlates. There was a question about that.
Well, the first thing that I would do is there's two options to really get started. The first option would be the free credit report. You can go out there to the website and just Google free credit report. And the first thing is understanding what is on your credit report. And then the other conduit is Credit Karma. Credit Karma is another service that you can go to and get a free credit report, or one that is fairly reasonable, and pull your credit. And the key is, Diane, is understanding what is on the credit report. So what do I mean by that? When you go to the free credit report or Credit Karma, they're going to tell you what your trade lines are out there under your name. And as you know, as I've shown through this small business lending, especially for startups, your personal credit is key in order to get in a small business loan. So understanding what's on that credit report, you normally have two categories. You have revolving, which a revolving would be maybe a line of credit, a credit card, or so forth. And understanding that utilization of that line has a lot to play with what your credit score is going to be. So if you have a $5,000 credit card out there and you've got $4,998 on that card, you have very little revolving credit left to get access to. And that actually impacts your credit score. So one of the first things that I do is that I make sure that they understand that the utilization of a credit card or a line of credit is very critical, because the amount that's out there actually hurts you. Below 50%, it's not that big of an impact on your credit. So you go from a 50% or less utilization, that means on that $5,000 card that you have at least $2,500 or more on that. And the other one would be installment loans. And that's more traditionally your auto lending loans, your home loans, and those loans are where you have fixed payment options. So you have your house, and say you paid $100,000 for your house, and you're paying 4% on it, and you have a $700 payment out there. So I don't know if it's 15, 20, or 30 years, but it'll tell us that. And what you do there that's crucial is that you don't have too much owed out on your installment loans. And what I mean by that, based off of the income that you make monthly and annually, you got to make sure that those payments don't go over the 43% debt to income ratio. So your payment amount per month divided by your income amount is what your debt to income would be, and that ratio needs to be 43% or less. Okay, and that's a little bit that's kind of hard for most people to understand, but I would be happy to help somebody. But on the credit report, the most crucial thing is past dues, delinquencies, foreclosures, and collection items. This majorly impacts your credit score. So those other two things, they do impact it, but it's less minimal. Your payment history is the most crucial thing, Diane, and that's why I always lead into that one last, because I want people to really know how important it is for them to pay their bills on time, to make sure that they have a good history with the people that you're already borrowing money with. So your past due collections and so forth. And we do understand that things do happen. COVID-19, you know, every 90 years, something like this has occurred, and it could result in a restaurant owner not being able to operate the restaurant business the way they did pre-COVID-19. We understand that, you know, there may be less cash there, but you need to try to make the best you can do on preventing past due and collection items.
You know, I've had several people ask me about different things. We could even do a whole webinar on credit, just because, you know, for instance, if somebody's looking for a mortgage, there's a couple of really great mortgage calculators out there online, but I think people struggle with the debt to income ratio because they're like, is it net? Is it gross? Does it include, my 401k or my medical or my dental, or, they're not sure what the number is and how to
Right.
figure that out. And so people struggle with, I think, the equations that go into some of those things.
That's right. And, just to make it real brief, the debt to income ratio, the way most financial institutions use it, it is your gross income. So all those other things that you talked about, your 401k and some of those other things that you take out after your gross income, we go off of gross income predominantly in the financial industry.
And what about medical collections? That's one I get asked about a lot too, because that seems to be the hardest thing, the easiest thing to go into collections, the hardest thing to pay off or make payment arrangements on.
Well, you're exactly right, Diane, because, it's the easiest thing to get into because most providers or hospitals and so forth, they will quickly move that off their books to a collection agency. So the biggest thing whenever you're pulling credit, and you may not recognize the name that has a line item out there, is more than likely you had a service rendered at a healthcare professional. They moved it to collections. Collection now owns it. So sometimes it could be of who do I pay?
Right.
You got to figure out who you pay, and pulling that credit report through Credit Karma or Free Credit Report will help you in understanding who it is that you pay to get that off your collection items. But you're exactly right. We do see a lot of collection items through that conduit.
Yeah, I've had people ask me about those quite a bit. So that's a really great overview on how some of that works. Because the rest of the question was disqualifiers, like what does the bank look at as a disqualifier? So I think you covered that when you were talking about the different pieces of it. And I do really highly recommend Credit Karma because they break it into those 4 categories that you were discussing and show you your percentages, and it's just a really great tool.
It is a good tool, and you get to use it once a year. You can go out there and do it once a year, or you can pay for the service to where you can have it ongoing, especially if you're repairing your credit. You can actually see when you do something how it does help the impact of your credit score.
Well, and I think too, one of the suggestions that I had heard before was like every quarter, take one of the different agencies and pull your free report from like Equifax or TransUnion, and if you do it, you rotate who you pull it from. That'll cover you for the year, so you can kind of keep up if you need to check it. If you're working towards credibility and bankability with a bank, so.
Diane, that's perfect advice. That's exactly what we tell them to do as well.
So that's awesome. Well, John, I think that's all the questions that we have in the chat box. This has been a really informational webinar, and we're looking forward to having this as a tool, as I know you are too, for all of us to be able to use it. This was a great wrap up to our sessions. We've had some really great presenters, some really great partners through the SBTDC and through the Small Business Center and through all of our folks here, some of our members. So thank you for presenting today. Thank you for wrapping up our sessions. And for folks who are watching this after the fact, next week, we will start back up October 1st. And we will have another round of sessions for October and November. So John, thank you. Thank you for being here today, and thank you for presenting and sharing all this information. I know it was time out of your day to prepare and time out of your day to be here, so we really appreciate it.
Well, Diane, thank you. I really appreciate you and Susan giving me the opportunity to do this video because our economy is being impacted and our small business owners are being impacted. So I really do appreciate you giving me the opportunity to present, because not only is it going to help me and my clients whenever I share the video, but hopefully it'll help the overall economy of the county. So whenever somebody goes in there for a small business loan, they're more prepared with their financial partner. So Diane, thank you. I do appreciate it.
Thanks, John. I appreciate you.
Bye-bye.
See you later.